The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast. How's it going, everybody? Welcome back to Trajecta Talks, the podcast where we unpack the tools, mindsets, and disciplines to help you get sharper in finance, business, and in life. I'm your host, Alex Savanovic, and I'm genuinely thrilled you're here for episode number 6. Whether you're commuting, hitting the gym, just chilling out, thanks for carving out some time with us. And if you're new, welcome to the show. If you've been with us since episode 1, I'm pumped you're back for another deep dive. Today's a special one. So, like I said, today, important topic, something that touches nearly every young adult and their family. Today, we are unpacking the real ROI of your college education. So, what does that mean exactly? For decades, college was seen as the golden ticket, so to speak, pretty much a guaranteed path to success and higher earnings. And for many, it absolutely still is, but let's be real, the landscape has changed dramatically. We're going to cut through the noise today, examining the true financial value of a college degree in today's rapidly evolving world. We will break down the different types of degrees, reveal which fields offer the best and sometimes the worst return on investment, and explore some incredible alternative paths to a potentially higher earning future. So, is college still worth it for everyone? That's the core question that we're tackling today. I don't want you to misconstrue this as nobody should go to college anymore. College is still a worthwhile investment for sure. This is just about making one of the biggest financial decisions of your life early on, a really smart one. So before we dive into the main topic, let's quickly hit our market update. The Trajecta Talks market hit list, your unfiltered weekly download straight from the desk. Let's get right into that. We have a super special market update today. Officially second quarter earnings season. So that's right. The numbers are starting to roll in, giving us our very first hard data points on how businesses are actually performing in this volatile environment. So let's pivot from the personal playbook to the markets playbook, specifically focusing on the critical earnings and headlines that have shaped this past week, right up to today, Thursday, July 17th, when we're recording this episode. Let's get right to it. First up, the semiconductor space, once again proving to be a dominant force in the market. Taiwan Semiconductor, that's TSM, just unveiled their second quarter results, delivering a strong beat across the board. Their profits soared by nearly 61% year over year, marking a new record and exceeding analyst projections. Revenue jumped over 38%, underscoring the relentless demand for cutting edge processors, particularly those powering the artificial intelligence boom for major players like Nvidia and Apple. While TSM's CEO did flag potential risks from shifting tariff policies, he noted no immediate change in customer order patterns. We've even seen some diplomatic efforts yield results, with Nvidia and AMD reportedly receiving US government assurances to continue shipping products to China. Still, TSMC is navigating headwinds such as strengthening Taiwan dollar and potential order adjustments from the smartphone and PC sectors. On the other side of the chip industry, we observed some significant turbulence. So ASML, that's the Dutch manufacturer of critical chip making equipment, experienced a sharp decline in its stock this week following its second quarter earnings report. So, despite new orders actually surpassing analyst expectations, ASML's CEO signaled uncertainty regarding growth projections for 2026, directly attributing it to the unpredictable nature of global tariffs. Their US listed shares fell by nearly 10%, with their Amsterdam shares similarly impacted. This tariff talk isn't theoretical. New duties could elevate the cost of ASML's essential tools for US clients like Intel, for for example. The downturn reverberated across the sector, pulling down other key equipment providers such as Lam Research, that's ticker LRCX, KLA, that's ticker KLAC, and Applied Materials, that's AMAT, AMAT. It's a clear reminder that even amid an AI driven boom, geopolitical policy can still significantly influence future industry trajectories. Now, let's discuss the specialized metals market. So, we did have a bit of news out of MP Materials, that's ticker MP. Saw its stock decline this week, paradoxically, even after Deutsche Bank raised its price target to a street high of $65. So, how does that divergence occur? You might wonder. Deutsche Bank maintained a hold rating on the stock, implying a maybe sort of a cautious stance despite the higher valuation. MP this also week had a monumental deal, I think, on July 10th with the U.S. Defense Department, which provides both capital and a guaranteed customer for domestically produced rare earth elements. So Apple also inked an agreement with MP Materials for access to non-Chinese sourced rare earth metals. And MP is planning a substantial 900% expansion in its magnet production capacity. It's worth noting that we at the fund were actively involved in the MP stock offering from Morgan Stanley this week. So, why the selling pressure? Often, even good news that precedes the future capital raises can exert downward pressure on shares. At times, you'll see that when there's a stock offering, either a selling shareholder or a company issuing stock, that shares do get hit initially. It might suggest that management views the current stock price as attractive for issuing new equity. Um, there's a couple things at play there. So, despite the week's dip, Wall Street largely remains optimistic about MP Materials. But this episode highlights that even with significant strategic wins, execution challenges and valuation considerations do persist and sometimes prevail in trading dynamics. Turning to the broader economic landscape, the initial wave of bank earnings indicates that the economy is maintaining a surprising degree of strength. So, we got some major institutions reporting this week. At least for now, it was JP Morgan Chase, that's ticker JPM, Wells Fargo, that's ticker WFC, Citigroup, that's ticker just C, alongside State Street, I think STT ticker, Bank of New York, that's BNY. Bank of New York Mellon, I should say, released quarterly results. So these reports collectively suggest that consumers are generally managing their debt obligations, and there's an increasing appetite for new credit from both households and businesses following a period of subdued loan growth. Corporate executives appear less apprehensive than they were earlier in the year. However, a noticeable disconnect remains: a fundamentally robust quarter for the financial sector against a backdrop of ongoing trade policy uncertainties, broader shifts in federal regulations. It's a little odd to see. So, while loan portfolios are characterized as good, the overall macro environment, I would say, continues to present a complex challenge, especially for this sector. In the healthcare sector, Elevance Health, that's ticker ELV, experienced a significant drop this week with shares declining over 11% after their second quarter earnings release. The primary driver was a sharp reduction in their full year earnings guidance, attributed to unexpectedly high medical spending and elevated cost trends within their Affordable Care Act and Medicaid agreements. So, although the second quarter adjusted earnings per share narrowly missed consensus estimates, their medical cost ratio increased. What's particularly interesting is to see ELV continue to act weak even after this report, especially since we'd already received earnings warnings from other players in the managed care space earlier this earnings season. This is sort of a red flag for the wider managed care industry. That's names like Humana, HUM, United Health, UNH, Cigna Corp, that's CI. Analysts are now suggesting that other major insurers, like the names I just mentioned, United Health, Cigna, Humana, CVS was another one I forgot of, CVS Health, could face similar cost pressures. So, keeping a close watch on these medical cost trends will be crucial as they appear to be more persistent than anticipated. Finally, let's talk some political commentary that invariably impacts market sentiment. I know you guys love it when I get to the politics in this podcast every now and then. So, President Trump categorically denied reports this week that he intends to dismiss Federal Reserve Chair Jeremy Powell. Such speculation historically has caused some market jitters. This time, the immediate market reaction was positive. Equities rallied on the clarification. Gold, I think, got hit a little bit. It's typically a safe haven asset, definitely declined as concerns about the independence of the Fed eased. This incident underscores just how sensitive markets are to any perceived instability within the Federal Reserve's leadership. And that, folks, brings us to the close of this week's market intel. It's been a dynamic few days with the second quarter earnings reports providing crucial insights into corporate performance. I'm super excited. We've got a few more weeks of earnings. So I think these next few market updates that we're going to have on the podcast are going to be super exciting. Stay tuned for those. Thank you so much. Let's get right back into the episode. So, the big question today, I know some folks are going to hear this and think that it's why go to college. I don't, again, like, I don't want that to be misconstrued as the topic of this episode. I want to focus on the ROI of your degree so you have a better understanding of what you can expect after graduation with whatever degree you've earned after 4 or 5 years in college. So, I just want to make that distinction very clear before we get into the episode today. So, college or university for generations, it was presented as the ultimate goal, the guaranteed path to a good job, a stable career, and a comfortable life. This perception was deeply ingrained in the North American psyche. My parents' generation, for example, saw a college degree as the definitive stepping stone to the middle class, an unshakable promise. Back then, simply having a degree, almost any degree, significantly boosted your job prospects and your earning potential. Industries like manufacturing, education, and even early tech companies often saw a degree as a mark of discipline and foundational knowledge, almost irrespective of the major. At that point in time, it was about opening doors that were otherwise firmly shut if you didn't have a degree. Then we fast forward a few decades. This is when the sticker shock comes. Tuition costs have been skyrocketing at an alarming rate. We're not talking about gradual increases anymore. It's an exponential climb. In the US, for instance, the average cost of tuition and fees at a 4 year public university has, I think, more than tripled since 1980. And that's even after accounting for inflation. As for the private universities, it's even higher. This has led to a staggering student loan debt crisis. Millions of young adults in both the US and Canada are now entering the workforce saddled with 5 figure, sometimes even 6 figure debt loads before they can even cash their very first proper paycheck out of university. Imagine graduating with 50 grand in student debt. With an average interest rate, you could be looking at monthly payments of several $100s stretching for 10, 15, even 20 years. This isn't just a number on a paper, it's a real financial burden that can significantly impact your ability to buy a home or save for retirement, start a family, even pursue entrepreneurial dreams if that's who you are. It's a weight that can follow you for decades. Now, let me be clear, and this is looping back to that point earlier where I'm not trying to turn you off from college. I'm just trying to make you understand the financial implications and the ROI of your degree. So, college does offer tons, immense non financial benefits. You develop critical thinking skills, the ability to analyze information, solve complex problems, and form reasoned judgments. These are absolutely vital in any career that you end up choosing. You expand your perspectives by engaging with diverse ideas, cultures, and people, which fosters a broader understanding of the world at large. You build valuable networks. This is a huge one. You form connections with peers, professors, sometimes alumni that can open doors to future opportunities that you never would have found out about or heard of to begin with if you hadn't gone to college. And of course, there's incredible personal growth, learning independence, time management, resilience when you finally move out on your own for the first time. These are truly all invaluable experiences and things to have. Uh, Although, before I move on, I want to put an asterisk on the expanding perspectives part that I did just mention. Some people, and I think that includes myself too, may argue that not all campuses promote the sort of diversity and opinion that everyone would hope college campuses foster. That's a discussion for another day. And I'm not even sure if it's a discussion for this podcast specifically. Um, but you've definitely heard about a few colleges, I think in the US, who are struggling with a opinion diversity issue. So moving on, when we talk about a decision that costs tens, sometimes hundreds of thousands of dollars, we have to frame these benefits within a context of financial decision making. So, can you get some of these benefits through other avenues or in combination with a more financially savvy approach to your education, perhaps? And that's what we're here to explore. Again, for the third time, I'm saying it in this podcast, I'm not trying to turn you off from college. I think it's a phenomenal option for everybody, and you should look into that as a legitimate option for your future. However, I did want to make this episode to make it known the ROI of different degrees and how you should be thinking about college from a financial perspective. Because while personal growth is great, if it comes with crippling debt, it can severely limit your options later in life. And for some folks, maybe it's worth looking at other options. I'm not saying for all folks. So, how do we actually deconstruct ROI? What does that stand for? So, ROI stands for return on investment. When it comes to a college degree, it's not just a buzzword, it's a crucial calculation, I feel. At its simplest, ROI is about comparing what you put in versus what you get out. And we use it frequently in the investment world. Think about it this way: to calculate a basic ROI for your degree, you'd look at your total lifetime earnings minus your total cost, then divide that by the total cost, multiply it by 100 to get a percentage. So if you couldn't do that in your head, I know I probably couldn't at some point too. So lifetime earnings minus total cost divided by total cost times 100. Just write that out as I'm saying it in the pod. So let's do a quick hypothetical. Say you spend 80 grand on your degree. That's tuition, fees, books, everything related to the schooling. And let's estimate that over your lifetime, this degree helps you earn an additional 500,000 compared to if you hadn't gotten the degree. Your calculation would be 500,000 minus 80,000, so that's 420,000 divided by 80,000 times 100. So that's 525% return on your investment. And that sounds fantastic, right? When you just look at those numbers, and those are pretty simple numbers without any adjustments. But this is where it can get tricky and that ROI starts to dwindle a little bit. Most people only think about tuition as their total cost. And that's a huge mistake, and it couldn't be further from the truth. We need to factor in a lot of hidden costs. So, one of the biggest hidden costs over the course of your university career is going to be living expenses during your studies. So, rent, food, utilities, transportation, the textbooks we mentioned earlier. You're going to need daily spending if you go out here or there. Even if you seldom go out, you're still going to spend money every now and then going out for a birthday. These can easily add another $15,000 to $30,000 per year, depending on where you live. And over 4 years, that's another 60 to $120,000. So, lost income during studies. This is the next one. If you're a full time student, you're likely not working full time or earning as much as you would if you had just entered the workforce straight out of high school. So, if you could have earned, say, 35 grand a year for 4 years, that's 140 grand in lost income, money you could have made. This is an economic term. They would call this opportunity cost. That's your opportunity cost. And crucially, all that student loan interest that compounds over time, that's another big one. If that initial 80 grand tuition was entirely financed by loans at, say, 6% interest over 10 years, you're paying back closer to $107,000. That's an extra 27 grand in just pure interest if you had taken out a loan to finance your education. So for our hypothetical, that 80 grand degree could easily, the total true cost, it could be upwards of 250 to $300,000 in real terms once you've factored in tuition, your living costs, your lost income, the opportunity cost, the interest of financing your education, and that drastically changes your return on investment calculation and brings it sort of back to reality. And it's not just about that starting salary right out of graduation. This is a good part, and it works a little bit in your favor. Well, that's a good initial indicator of what you're going to make over a lifetime. The real measure of return on investment comes from your mid-career and lifetime earnings. So some degrees might start lower but have significant growth potential. I know it does typically work like that in finance, and certain research heavy science fields that require postdoc work, but they pay off immensely once you get to that point a few years down the line. Others might start strong, but plateau very quickly. You won't make a lot more than, let's say, what you make after the first 5 years post grad. You also need to consider the benefits. This is a huge one. So, if your employer pays for health insurance or makes retirement contributions, if they give you paid time off, that can add significant value to your overall compensation package, and you have to factor that in. This is where the deeper research and long term perspective come in. We're going to talk about high ROI versus low ROI fields. Based on recent data, some degrees consistently stand out in the winner's circle for their strong financial returns. And again, I'm not including this section to turn you off or turn you on as it relates to what you're interested in. I'm just providing information so you can understand where some of these fields stand from an ROI perspective. So, first up is the STEM fields. This is almost a no brainer: science, tech, engineering, math. Think specific engineering disciplines like chemical engineering, computer engineering, aerospace engineering, civil engineering. These roles are foundational to our modern world and constantly in demand. So average starting salaries for many engineering grads can be upwards of 70 to 80,000. I've even seen some of my friends make 100 right out of the gate, quickly climbing to six figures within a few years. Computer science and IT are also consistently top performers, covering everything from software development, data science, cybersecurity, cloud architecture, and AI engineering, which is a big one right now. The demand here is absolutely insatiable, and salaries truly do reflect that. Next up is healthcare. Although going to med school is a massive time and financial investment, obviously doctors do make that ROI later on. Nursing is huge. Registered nurses, nurse practitioners, these professionals are the backbone of our healthcare system, and their skills are always needed, offering excellent stability and competitive salaries all the time, especially in Canada. Beyond nursing, consider allied health fields like physician assistants, physical therapists, occupational therapists, medical laboratory technologists. These roles are essential, always in demand, well compensated. Many require a master's or PhD, but offer a clear path to a high earnings potential. And for those of you interested in the finance world, although if you're listening to this podcast, I don't know why you would be. Wink, wink. Specific business degrees like accounting and finance also show consistently strong returns. So, a robust accounting background opened doors to jobs in auditing, financial analysis, corporate finance. Finance degrees can lead to careers in investment banking, portfolio management, corporate finance, and risk management, which are consistently, I would say, at least given what I've seen, among the highest paying fields in finance. As it relates to being on the sell side, I think on the buy side, there is a lot more upside, and we can talk about that on another episode. So, now for the proceed with caution list. Again, I'm not trying to turn you off from these things. If you're truly interested in them, chase, a passion. We're going to get into passions versus payment later on, but these are degrees that on average tend to have a lower return on investment or often require significant additional education to pay off, like a master's or a PhD, um, to see substantial financial returns. So we're talking about some humanities, arts, even certain social science fields without further specialization. So let me be clear. Like I said before, this isn't to say degrees are worthless at all. I'm not saying that. They offer incredible value in personal enrichment, critical thinking, communication, understanding the human condition. These are skills that I have lacked for most of my life and have only picked up on in the last few years. And they're absolutely vital in society. And I wish I had spent the time early on to go through some of that stuff, maybe in a little more detail. But for those primarily focused on the financial return and minimizing debt, which is the purpose of this episode, it's important to go in with eyes wide open and understanding all your options and the ROI of all these options. So, a history major might need to pursue law school, or a philosophy major might need a master's in a more applied field like data analytics. Or they could combine their critical thinking skills with specific tech certifications to make their degree pay off significantly, or at least pay off more than it would have if they hadn't. So, like I said earlier, that we would get into this passion question, the perennial passion versus practicality debate. So, how do you balance pursuing what you love with making a financially sound decision? So, often you can absolutely combine them. Sometimes you can't, and sometimes people force, round peg into a square hole, and it ends up crashing and burning later. Or sometimes they just go through a whole life of unhappiness. So, I truly believe that you can find a combination of the two. You do have to work hard, though. There's no such thing as avoiding working hard. So, for example, minor in a high demand field. If you love literature but want a practical edge, minor in something like computer science or something related to business, business analytics, marketing. That's an option number one. Option number two, there's dual degrees. Some universities offer programs that allow you to pursue two bachelor's degrees simultaneously, giving you both breadth and specialization. That's a cool option. The next thing is strategic internships. I've seen tons of my friends do this where they were studying something in the arts, and regardless of their major in the arts, they seek out internships in industries that interested them and offered some growth potential. So this is often how humanities majors, arts majors pivot into tech or business roles. They go and apply relentlessly, and someone takes a gamble on them and they knock it out of the park with the role and get a job offer later. Next up, we're going to talk about leveraging transferable skills. So, focus on the critical thinking, research, communication skills inherent in the arts degrees or humanities degrees, and learn to articulate how they apply to business or tech roles. I know a lot of people in business or tech that suck at giving interviews. They should watch the career episode they released last week. But the people in arts tend to really knock it out of the park because they're just good, personable people a lot of the time. Uh, it's truly about being strategic and proactive in how you build your resume and skills, not just relying on the degree itself. When I got my finance degree from the Sauder School of Business at UBC, it felt like the traditional path was the only path. But my experience working at a hedge fund taught me to think strategically about all paths to success. And honestly, while I was in Sauder, they really only sold me the idea of going into a sell side role. And it wasn't until I got this job that I realized the buy side was truly for me. So that's what I mean when I say crucial to look at beyond just the bachelor's degree and explore all educational avenues. The world has definitely changed, and what defines a successful career path has broadened significantly. So let's get into a couple of those things. What I'm talking about, what is this guy rambling on about? First one is associate degrees. These are seriously underrated and often misunderstood. Uh, I know it's on paper, people are like associate's degree and start to freak out. So an associate's degree, typically a 2-year program offered at community colleges, can provide direct entry into skilled trades and certain technical roles much faster and more affordably than a 4-year degree at a big university. At least in my hometown, I know BCIT was an example of something that offer a school that offered this sort of thing. Um, Roles like web developers, dental hygienist, registered nurse. There's some bridging programs. There's many types of skilled trades, often only require an associate's degree that you can get at one of these schools at a fraction of the cost. They offer a focused curriculum, direct vocational training, and can lead to immediate employment with really good earnings right off the bat. Many of these jobs pay upwards of 50 to 70 grand annually with significantly less debt than a 4-year university. Next up, we're going to talk about trade schools, which sort of ties in really well with point number one about associate's degrees. This is perhaps the biggest hidden gem for high ROI, and it's definitely starting to get a little more popular in today's news. I've heard it on a few other podcasts. There's a massive demand for skilled tradespeople in Canada and the US, and the workforce is aging, creating incredible opportunities. So things like electricians, plumbers, HVAC technicians, welders, heavy equipment operators, excuse me, these professions are essential, recession proof, and often pay six-figure incomes once you're established. Programs at trade schools are typically much shorter as well. Like I said, in the associate's degree part, those are 2 years, but I've seen some programs as little as 6 months. They're significantly less expensive and provide hands-on practical skills. You're earning a lot sooner and incurring far less debt. So don't sleep on the trades. I know it's not the sexiest thing in the world, and people don't look there as like a place that you can make a lot of money, but you can. Um, don't sleep on the trades. That's it. They are the backbone of our economy, and there's a lot of dollars to be made there, I think. Certifications have become a really big one. So, especially in the rapidly evolving tech sector, things like coding boot camps or specialized IT certifications can be powerful accelerators. These aren't full degrees, but intensive programs, 3 to 6 months, and sometimes even shorter, designed to teach a specific in demand skill set. So think of certifications like Amazon Web Services Certified Solutions Architect or Google IT Support Professional or project management certifications like PMP. Coding boot camps can transform someone with no prior tech experience into a junior software developer. These are viable alternatives or powerful complements to a traditional degree that you got at university, equipping you with highly marketable skills in a super short time frame. I do want to caution you with the this rise in AI. A lot of these skills that you could get through a boot camp or a certification class, a lot of those skills will be, I think at least, performed by AI, if not this year, in a few short years. So make sure you're not wasting your money on something that can be very easily automated. So these certifications are particularly effective if you already have some foundational knowledge or a bachelor's in another field and want to pivot or specialize. And finally, we're going to talk about self education and entrepreneurship. I want to put a big asterisk on this one. It's not for everybody, it requires a lot of risk taking, a lot of hard work. It's not for the faint of heart, but I do have to include it in this episode because it is a viable option for that small percentage of folks. So, in today's digital economy, we're seeing more and more individuals create incredibly successful careers without a traditional degree simply through relentless self learning, strategic networking, and starting their own ventures. This isn't just about dropping out and hoping for the best. I want to make that so brutally clear. I don't want someone to hear this and go out and quit school. That's absolutely not what I'm suggesting. This requires immense self discipline. These individuals leverage online courses from Coursera, Khan Academy, you name it. They read extensively, they find mentors, build portfolios of work, especially if they're in the creative fields or tech fields, and they start their own businesses. So think of successful YouTubers. I know you've heard of Mr. Beast, Kai Cenat, some of these guys, digital marketers, software developers, or consultants who built their empires from scratch. It's not for everybody. Like I said at the beginning, it requires a high degree of initiative, but it's definitely a path to consider, especially if you have a strong entrepreneurial spirit and maybe some backing money. So, how do you make your college decision a smart one? This is where the rubber meets the road, and the Trajecta Talks principles of strategic thinking really come into play, I think. Firstly, number one, research, research, research. I've said it 3 times because this cannot be stressed enough. Before you even apply to a school or declare a major, look up the average salaries for specific majors and jobs you're interested in. Don't just pick a major because it sounds cool or your friends are doing it. That couldn't be any sillier if you made a decision based on that. Use reliable sources like government labor statistics. I know those are boring, dry websites, but they have plenty information. Um, you can go on the Bureau of Labor Statistics in the US. Statistics Canada is the one we have here in Canada. Go on Glassdoor. See what the average salaries are for different employers. LinkedIn Salary is a great resource. There's also some industry specific reports, I think, on CoStar Group. All of that initial research can save you years of regret and tens of thousands of dollars. Next, let's talk about cost versus value. Compare tuition rates relentlessly. A degree from a public in state university in the United States is often far more affordable than an out of state public or private school. A lot of the time, it's because they charge out of state people fees. And same goes for foreign students in Canada. They charge them a lot more. So don't assume a higher price tag automatically means a better education or a better job. And crucially, factor in scholarships and financial aid. Fill out your FAFSA's free application for federal student aid in the US or explore provincial federal aid programs in Canada. Actively seek out grants. That's the money that you don't have to pay back, and scholarships. There are thousands of them out there for sometimes really silly things, but they're out there. It's free money. So go and apply for them. Why not? And they often get overlooked. Every dollar of grant or scholarship money is a dollar that you don't have to borrow. That's an extremely important concept to understand. Understand the difference between subsidized and unsubsidized loans, and always prioritize grants over loans. Let's talk about flexibility and adaptability. The job market is constantly changing. A decade ago, a data scientist wasn't even a common job title, if it even was one. 5 years from now, new roles will emerge. And I think that's even more pertinent today with the emergence of AI. Um, so we can't even, there's going to be so many jobs that we can't even imagine today. So choose a path that provides some transferable skills. What are these? Critical thinking, problem solving, effective communication, both written and verbal, effective communication, digital literacy, financial literacy, collaboration, adaptability. These are skills that are valuable in any industry, in any role, regardless of technological changes or shifts. These are the skills that apply to any job. And those are sort of the soft skills that maybe not everyone focuses on learning while they're in college. They maybe just focus on learning those hard skills. Focus on programs that emphasize these core competencies rather than just rote memorization of facts. Networking is another big one. College isn't just about the classes that you take, it's about the people that you meet. That's never been more true. Leverage that experience for career connections. Go to career fairs, even if you're only a first year student. Talk to professors during office hours. They often have industry connections and insights. I really encourage you guys to join clubs and organizations, especially things related to your interests or potential career paths. That was something I didn't do while I was in UBC that I really wish I had. I look back on it. It's one of my only regrets about university, that I hadn't done any clubs or other organizations. So seek out internships, even unpaid ones, early on, as they provide invaluable real world experience and build your professional network. I would really strongly suggest that you use LinkedIn strategically to connect with alumni from your school who are in the careers that interest you. I know I talked a little bit about that on the last episode. Your network can be just as valuable as your degree, sometimes even more so. This decision is huge and it's worth thinking critically about. We want to empower you, our listeners of the Trajecta Talks podcast, to make the best possible choice for your financial future. As we near the end of the episode, I want to say that this podcast, like I've said before, thrives on your input. Last week's questions were great. Keep them coming. You can DM us on Instagram, LinkedIn, Facebook, or you can hit us on the website. All links are going to be in the show notes below. And as I've said in the past, this episode is brought to you by Trajecta University. That's my passion project to teach financial literacy and real world skills. We offer courses for students, career coaching. There's seminars on budgeting, taxes, investing. There's one-on-one sessions with finance pros. Our mission aligns perfectly with today's discussion. Truly, we're just trying to help you navigate these complex financial topics and decisions in your life and build a strong foundation for your future. Now, you thought we were going to end off the episode there. We got one more thing to talk about. Let's get right into it. The first two submissions for the Trajecta Talks stock picking competition. I'm super fired up. It's the first two submissions. So let's talk about them a little bit. It's awesome to see this engagement and the early picks coming in. It really fires me up. So we've got two interesting plays this week. By the way, I'm not including any last names. We're just going to use first names and talk about the decision. Next episode, we're going to dissect how they did, what the performance of the stock was. So first up, we have Hunter. Hunter's submission, he said short sell OKLO. That's OKLO. Hunter jumped in with a short sell there. Submitted it on Tuesday, July 15th at an approximate price of $62. I think I'm being a little bit generous there. So OKLO Incorporated trades on the New York Stock Exchange. It's an advanced nuclear technology company based in Santa Clara, California. We did actually talk about it on one of the market updates a few weeks ago. They design compact, fast reactors with the aim of providing clean, safe, and affordable energy. They're also working on producing radioisotopes through their nuclear fuel recycling process. So a short sell for those new to this or new to investing, it's a bet that the stock price will go down. So, what is Hunter thinking? Well, shorting can be a strategy when an investor believes that a company is overvalued or has upcoming negative news. Like I said before, you're just making a bet on the stock going down. So, I don't know what Hunter's thinking with this was, given the market has gone nothing but up the last few weeks, it seems. I have not been personally paying attention to OKLO as of recording this episode, but now I sure will. It'll be really interesting to see if Hunter's bearish outlook plays out, especially with all the recent buzz around nuclear energy. Next up, we have Jackson. Jackson's submission, he was long circle, that's CRCL, and he's on the other side of the trade. This submission came in on Friday, July 11th at $187.40. So Circle Internet Group Incorporated trades also on the New York Stock Exchange. Ticker is CRCL. Operates as a global financial technology company, providing a platform network and market infrastructure for stablecoin and blockchain applications. They are notably known for issuing USDC, that's a US dollar denominated stablecoin. So going long, of course, is the more traditional approach to investing, especially if you don't have a margin account. So this sort of means Jackson believes that Circle's stock price is possibly heading up. He might be seeing strong growth potential in the digital finance, stablecoin market. I gotta say, I wish I was long Circle earlier. I can't remember what the price they IPO'd at was. We definitely talked about that on the market updates of one of those last few weeks too. I want to say it was a $40 IPO, and it's now 180 bucks, which is kind of nuts. And that's also because Bitcoin and a lot of these coins have gone straight up in value. Um, so, like I said, digital finance, stablecoin market, maybe they're solidifying their position in the future of finance, especially with this administration. Sorry, these are our first two entries, so we don't have much performance to report on just yet. But it's great to see Hunter and Jackson stepping up with some conviction here. I love to see it. We'll be keeping a close eye on OKLO and CRCL this week. We'll check back in next episode to see how their picks performed, and if there was any new insights that we can glean from the market's reaction to those picks. So if you love the markets as much as we do and want to learn more about stocks that maybe you're watching, DM us your stock picks, just like Hunter and Jackson did with CRCL and OKLO, along with your name. We'll pick a few every episode to dissect, talk about on the show. We'll be looking at the timestamp of when you sent the DM to gauge roughly what your entry price was. And we will track the performance weekly to keep everyone engaged and learning more about their picks. I am hyped for this, and I hope you guys are too. Thank you so much, Hunter and Jackson, for contributing your picks to the show. All right, folks, that is episode 6 in the books officially. We've covered everything from reimagining the purpose of college to deconstructing your return on investment, exploring value degrees, and looking at exciting alternative educational paths. So I think the big takeaway here, your education is an investment. You should 100% view it that way. It's a massive investment too. Understand its real cost, the things that we talked about outside of your tuition, the potential return, and choose the path that best aligns with your goals. Control your credit, control your future, and now control your educational investment. If this added value for you, please subscribe to us on Spotify, Trajecta Talks. And if you like to watch your podcasts, you can catch the full episodes on YouTube. The link for that is also below. And if you want to learn more about Trajecta University's courses or the stock picking competition that we just discussed, visit our site. All of this is linked in the show notes down below. Share this episode with a friend who needs it. That's how we spread the edge and build better financial literacy. Thanks so much for being here, folks. I'm Alex Savanovic. This is Trajecta Talks. I'm going to see you folks next week. I hope you have a very happy Friday. Take care, everyone.